Why is institutional capital transforming the future of agriculture? Imagine a world where massive pools of money flow into farmland, changing how food is grown and who owns the land. That's what is happening now with institutional investors. Institutional capital comes from organizations like pension funds, insurance companies, and large investment firms. They see farmland as a steady, long-term asset that can grow in value over time. These investors treat farmland like they do with commercial real estate or stocks, but with some key differences. Farmland offers stable income through leasing or crop sales, and it can act as a hedge against inflation. Since the amount of farmland is fixed and global food demand keeps rising, it becomes a very attractive investment. This is especially true in regions like North America, South America, and parts of Asia where farmland productivity is high. When these big investors buy land, they often pay prices that local farmers cannot match. This pushes farmland prices higher and shifts the local economy. Large-scale investors and farming companies gain access to new technology and capital, which can boost productivity and efficiency. Smaller farmers might find it harder to compete as land prices rise. One major change is the rise of farmland investment funds. These funds pool money from many investors to buy and manage farms. By 2025, global farmland investment funds are expected to reach $60 billion, up from $40 billion in 2020. These funds give investors a chance to participate in agriculture without needing to run a farm themselves. Over the past 10 years, farmland investments have averaged about 11% annual returns, often beating traditional real estate. Different types of farmland funds focus on various crops. Some invest in row crops like corn, soybeans, and wheat, which are planted and harvested every year. Others focus on permanent crops like orchards and vineyards, which can offer higher returns but come with more risk. Technology is also playing a big role. Large investors often bring in tools like precision agriculture, satellite monitoring, and data analytics. These tools help farmers increase yields, cut costs, and reduce environmental impact. For example, satellite crop monitoring can verify harvests for insurance and loans, making capital more accessible and reducing fraud. New financing models are emerging too. Traditional bank loans are being supplemented with data-driven lending that uses real-time performance metrics. This can help smaller farmers get credit more easily. But there are challenges. Farmland markets are still slow to buy and sell, with low turnover rates. It can take time to transfer large parcels of land, and ownership changes happen gradually. Even though institutional investors now own a bigger share of farmland, they still hold only a small part of total ownership in most regions. Looking at farmland investment strategies and trends, it's clear that institutional capital is shaping the future. It offers opportunities for diversification, inflation protection, and strong returns. At the same time, it brings new technology and management practices to farming. But it also raises questions about access and affordability for smaller farmers and rural communities. For viewers interested in this area, learning about different farmland funds, how technology is changing farming, and regional market trends can be very helpful. The influence of institutional capital is growing, and understanding it can help you make smarter decisions whether you are investing, farming, or just curious about where your food comes from.